Feeling overwhelmed by the stock market's ups and downs, endless charts, and intimidating jargon? You're not alone. But guess what? You don't need a finance degree to start building wealth. Stick around to discover the 5 crucial things every investor should know before diving in. Investing can often feel like a daunting task, especially when you're bombarded with complex terminology and market volatility. But understanding a few foundational truths can transform you from a cautious observer into a savvy investor. In this video, we'll explore the top 5 essential concepts to help you navigate investing with confidence and long-term success. Whether it's market dynamics or the importance of owning real businesses, these insights will empower you on your investment journey. Here's a sneak peek of what you'll learn: why the market's ups and downs are more predictable than you think, the importance of viewing investments as stakes in real businesses, deciding between dividends and growth, the power of time in the market, and why knowledge is your greatest asset. These key points will help you build a smarter, more resilient portfolio. Let's kick things off with the most fundamental concept: the market goes up and down. While this may seem unsettling at first, it's crucial to remember that historically, the market tends to rise over the long haul. For instance, the S&P 500, which represents 500 leading U.S. companies, has averaged a 10% annual return, despite facing numerous global challenges like wars, pandemics, and economic downturns. The lesson here is simple: avoid the urge to panic when your portfolio drops. Selling during downturns can lock in losses. Instead, adopt a long-term mindset and view market dips as opportunities, not threats. By staying invested and patient, you're more likely to benefit from the market's natural upward trajectory over time. Next, let's dive into the real essence of investing. You're buying pieces of real businesses. When you purchase a stock or an ETF, you're not just performing a digital transaction. You're acquiring ownership stakes in companies. Owning a share of Apple means you're part of the enterprise that produces innovative products like the iPhone. Investing in an ETF means you're diversifying your ownership across multiple companies. This understanding helps differentiate investing from gambling. By focusing on companies with solid foundations and growth potential, you set the stage for fruitful long-term investments. Shift your perspective from short-term gains to nurturing business ownership, and you'll likely see your investments flourish. Another key aspect to grasp is the difference between dividends and growth. Some stocks and ETFs distribute profits to shareholders in the form of dividends, providing regular income. In contrast, growth-focused stocks reinvest earnings back into the company to fuel expansion, aiming for value increase over time. Both strategies have merit. Looking for immediate income: dividend-paying stocks like those in ETFs such as SCHD or VYM might be suitable. More focused on long-term value appreciation? Consider growth-oriented entities like Google or ETFs, such as VTI. The strategic tip here is to balance your portfolio, incorporating both dividends and growth to align with your financial goals. Let's conquer one of the biggest misconceptions: timing the market. Many investors try to predict the perfect moment to buy or sell, but even the pros often get it wrong. Instead, the real power lies in time in the market. Investing steadily over a long period allows compound interest to multiply your wealth. To illustrate, if you start investing $100 monthly at 18, by the age of 40, you might accumulate over $80,000 with normal market returns. Starting the same habit at 30 significantly reduces this figure. The big takeaway? Start early, invest consistently, and let the magic of compounding work on your behalf. No fortune-telling required. Finally, let's emphasize the importance of learning before you leap into the investing world. Avoid the pitfalls of blindly following social media trends or hype without foundational knowledge. Understanding concepts like stocks, ETFs, PE ratios, and capital gains taxes will boost your confidence and decision-making. You don't need to grasp everything immediately. Educate yourself gradually. From platforms like Investopedia.com to channels like Joseph Carlson's on YouTube, a wealth of resources is at your fingertips. By prioritizing knowledge, you set the stage for informed investing, which is the cornerstone of success. Remember, by investing in your financial education, you're paving the way for monetary returns down the road. Let's quickly recap what we've covered. The market's natural fluctuations shouldn't deter you. Owning stock is owning part of a real business. Choose between dividends and growth depending on your goals. Prioritize time in the market over timing it. And always arm yourself with knowledge before investing. Embrace these principles, and you'll be setting yourself up for long-term success. Now that you know the key factors every investor should understand, what's your next move? Are you going to start small and build your knowledge gradually, or do you have specific companies in mind you wish to explore further? Share your thoughts in the comments below, and don't forget to subscribe for more insights on building a solid investment strategy.